Doc Severson has been actively trading the stocks, futures, options, and cryptocurrency markets since the 1990s, and his specialty is finding edge with the same basic chart analysis techniques that he outlines in his latest Amazon book, Fractal Energy Trading: 4 Simple Rules to Profit in Any Market and Any Time Frame. Doc has taught these principles to thousands attending his online webinars, live seminars, and trading courses, and become the go-to source for understanding how to find opportunities through multiple time frame price-based charting techniques. His companion book, Hacking the Holy Grail: The Trader's Guide to Cracking the Code of Profitability, addresses the myriad mental roadblocks that come with making decisions in the face of risk, and is a stumbling block to traders of all shapes and account sizes until they find that the trader's holy grail is not the magic trading strategy that they're looking for. The holy grail of trading is actually between their ears. Doc has been helping students in all countries and backgrounds simplify their trading approach to a market since 2005, and his current platform at readyset.trade, where he conducts live trading room to help retail traders build a system to create consistent income opportunities targeting profits of $100 a day. So Kate, go ahead and turn it over to Doc, and I will try to get reconnected with you on a different computer.
Hi, Doc. Yeah, go ahead and share your screen.
Okay, Kate, can you see my screen now?
Yep, we're all good to go.
Okay, thank you very much. And let's get started here. Again, guys, my name is Doc Severson, and I'm an individual trader and performance coach. I've been around since about 2005, and this is when I quit my 6-figure job and started working from home. Current services that I run is readyset.trade as well as readysetcrypto.com. You may have heard of me at either OptionsMD or TheoTrade or Doc's Trading Tools or Options Linebacker, but my current services, again, readyset.trade, readysetcrypto.com. And over that time, everybody gets a specialty, and my specialty is looking at price analysis from multiple timeframes and using those to trade options and futures. And due to, I guess you'd say, having to eat my own dog food here, I've had to understand why we make the decisions that we do. So I've become an expert in trading mindset. And really what I try to do is to simplify the complex. There's so many complex things that are out there in trading. They don't need to be. And so what I've done is written a couple of books on these. So first of all, the most recent one is Fractal Energy Trading. And this is about how to use multiple time frames to really isolate what's happening in the price and really understand what's happening in the price instead of using lagging studies, as well as the mindset book that I wrote a few years ago is called Hacking the Holy Grail. Both of these are available on Amazon.com. Just look for Doc Severson under the search bar, and you can find it. Okay, so what am I going to do today? My purpose today is, look, there's a lot of new investors that are out there that have discovered markets, and a lot of folks have come on board through social media. And the problem here is that social investing is not effective. You're going to be following the crowd one way or the other, and they're always going to be the last ones on board. So if you want to become a bag holder, go on to Wall Street Bets and follow everybody else. If you want to trade with edge, you have to find a specialty. And my specialty that I'm going to talk today about is being flat by the end of the day with these 0-day options. And in today's environment, that may be a really, really good thing to be flat by the end of the day. You never know when these 7% circuit breakers days are going to show up. Okay. These are some of the best natural edges that I've seen available to retail traders in a long time. These will not go away. That's not going to be some flash in the pan that once you learn about this a year later, they won't work anymore, or the market's going to change in such a way that the edge is gone. These will stick around for forever, as long as there's trading. So my job today is to walk you through this, show you the system, show you why it works, and help you decide if this is something that's for you. Okay, so ready, set, let's get going. Let's talk about why we're here today. We're here for financial freedom. Everybody's here to learn about financial freedom, but using yesterday's methods won't work anymore. You could probably still connect an old rotary dial phone to that, but quite honestly, everybody's on a smartphone. So what we've all kind of come to accept is that the traditional way, the old paradigm, is to grow your pile, build your pile of assets, and everybody still is very comfortable with that. So start out with something small, build it into something big, and then live off of that. And so the thing here is that once you build your pile of assets up big enough, you can live off the interest. The old standard was to build up $1 million and then you'd earn 50 grand a year. And most people could at least function off of 50 grand a year, which is what you'd earn at 5% APR. But that's not happening today. The problem here is that interest rates are still pretty low and inflation is super high. They are not producing useful yield. So you're falling behind no matter what you do. And we all know why this is happening. We don't need to go into reasons why this is happening. So the alternatives to savings interest, if that's not going to be functional, is we can get into annuities. You'll hear people talk about annuities, but they're going to lock you in for years to receive a tiny rate. Also, you can get into bond yields. A lot of people buy bonds, but look at the rate that they're getting, 2% for a 10-year note. Seriously? Or you can get into stock dividends, but what you'll find is that the bigger the dividend, the worse the chart looks, like this one that's paying a 25 or a 20% yield, but the chart looks terrible. So to me, everything in the old paradigm of financial services, which was based around annuities and interest rates and bond yields and stock dividends, they just don't work in today's environment, and you're going to fall behind. So the problem here is that we're going to be burning through our principal in no time at all. So in the immortal words of Private Hudson, what do we do now, man? Game over. I don't think so. There's something else that we can do about this. So we can pursue what's called income. Income to the rescue. We can achieve passive income, and this is earned without active participation. This is truly where your money makes money for you. And typically, you're used to hearing about this through interest and dividends, but there's other ways to do this. Now, active income, you're also familiar with. This is typically something that you have to do to earn income, which is a job or active trading. So these are different types of passive and active income that can work to replace these old vehicles that we have. Now, can we use stocks for this? Can we just trade stocks alone? I don't think so. I don't think it's a good idea. The market right now is way, way up, right? And everything is relatively expensive. If you haven't noticed, right, the S&P is up 533% from the lows in 2009. We got asset inflation in stocks after the great financial crisis back in 2009 ended. And so it left a lot of people on the sidelines. And if we want to trade the market leaders, we're going to be dealing with Amazon at 2,900, share of Tesla is $790 today. So unless you want to wait around for them to split, you're going to be tying up a lot of capital holding these shares and trying to trade in and out of them. So how can you create income trading in and out of these things? Well, you can do day trading, but for most people, this is prohibitive, right? You've got to have at least 25 grand. Otherwise, you're going to be hit with pattern day trader. And a lot of people, it used to be that $25,000 was a small account. It's not so much anymore. There's a lot more people that are trading out there with much smaller accounts. And the pattern day trader rule does not really support their activity. Okay, so what are we going to do here? How about trading options? Yes, this is a solution for us. So with passive income, we can sell longer term options to act like an insurance company, right? We're going to be being paid for taking on that risk. We're selling the risk premium to buyers, and we're trying to manage the risk on the back end. Or active income, we can look for short-term opportunities to either buy or sell options using the leverage of those options to more efficiently use capital. So here's what my assumption is for today, that being part of a John Thomas webinar means that you guys are at the very bleeding edge of what's going on in the markets. This is not your first trip around the block. So I'm going to skip the usual background on options, get right to the strategies, and focus on this point here. How do we generate active income using 0 days to expiration option strategies? All right, let's get into that. Now, the first thing I want to cover is about our goal, because you said your goal was financial freedom, and to get to financial freedom, you need to replace your income. And I don't care what your income is today from your job. Let's start out by having a reasonable goal of earning $100 a day in income. Now, a lot of people, and every time I give this presentation, I get people complaining like, are you kidding? I can't do anything on $100 a day. Okay. That's great. I understand that, but you've got to start somewhere. So just having a demand like, hey, I need, $5,000 a week or whatever. Okay, that's great, but you gotta start somewhere. Understand that tiny gains add up. You gotta start somewhere, guys. I mean, if you're batting in Major League Baseball, you gotta start at home plate. You can't just start at first base or second base or third base. You gotta start at home plate. You gotta earn away around the trip, all right? So understand this. If you start somewhere, and this is where you're starting today, wherever it is with your trading career, if you start here, if I were to throw a challenge out to you to say, could you get better 1%? Could you get 1% better between today and tomorrow at what you do and your ability to trade strategies? And I think just about everybody listening right now would agree that, yeah, I can do that. Doc, I can do that. I can get 1% better between today and tomorrow. Okay, great. Awesome. We're off to a really good start. Now, tomorrow, do the same thing. And the day after that, and the day after that, keep doing the same thing. Keep going after that repetitive gains. Tiny gains add up. Getting 1% better every day at something means that by the end of the year, you're going to be almost 38 times better at something. So what we're going to do is we're going to pick one thing, start with a modest goal, whether it's $100 a day or even $10 a day, and continue to improve on it every single day. What I like here is instead of most people learning about one strategy, trying that a couple of times, and then bouncing over here, and then trying this a couple of times, and then bouncing over here, right? We all do this. We all try something a couple of times until we lose some money at it, and we say we give up and we start running around, and eventually you end up right back where you started again. And instead of getting 1 year of experience, you're getting, 1 month of experience 12 different times. You're not going to get where you want to be. So trading 0 DTE options allows you to get lots of trades, potential improvement over the span of a year. This is how it's done. Now we can apply this through what we call the income pyramid. So we don't have to use our entire account. It's something like this. So a lot of my really slow and long-term trades are down here in non-directional index trades. They're really easy to manage. Things happen in slow motion. And I can add a little bit more risk by adding equities to that, which have a little bit more implied volatility, usually with less capital. And then I can get into some of the directional trades or maybe even futures trades if I want to intraday. So I'm using less capital on these types of 0 DTE trades. Now, your approach is going to be different from the next listener. Everybody's got a different combination of capital, knowledge, and time available to it. Some people have 24 hours a day minus sleep that they could literally apply towards this. Other people are working full-time jobs and only have maybe 15 minutes a day that they can do something, or one small window that they can trade within. Some people have lots of capital to work with. Some people have a small amount of capital. And then there's knowledge, which is the big wild card here. And I would say of the three, knowledge is by far the most important because it will never go away. Once you learn something, you're set for life with this. And then you can work on expanding your capital, maybe expanding your time, but start with knowledge on here until you get your optimal Venn diagram and that combination of knowledge, capital, and time for you. Everybody's going to have a different approach. You need to figure out what yours is. Now, this is a little bit easier with larger accounts if you want to earn either active or passive income. Let's just assume that you don't maybe have a larger account. You can't just sit there and write puts every month and make your target. So again, what we'll focus on today is active income using 0 DTE trades. So we're going to place them and remove them in the same day. We're going to be flat by the end of the trading day. And if we only do them 3 times a week, we can avoid small account or pattern day trader account lockdown issues. Okay, so active income, we're flat at the end of the day, and away we go. Okay, next section. So let's get into actual 0 DTE options. Again, it shouldn't be a surprise. These are 0 days to expiration options. These are ones that expire today. Now, you may have heard of weekly options before, and most equities have these already. And these came along maybe 15 years ago. Here's a monthly cycle, and then here's the weeklies, and this is next Friday. This is this Friday, here's next Friday, here's 2 weeks from now. April 1st comes up 2 weeks from now on a Friday. These are weekly options as well, but each one of these are Friday options. Okay, so we could do those. That was a big deal back then, 15 years ago. Oh, we have an option that expires today. You know, we can do these 4 times a month. This is awesome. Okay, but the S&P 500 has 3 times a week. And guess what? This is going to be 5 times a week by this summer. This is what we've been promised, is that we're going to have options that expire every single day by sometime this summer, late second quarter, early third quarter. That's what I call summer. So notice here that here's an option that expires today, 14 March. Here's another option which expires on Wednesday. Here's one that stops trading on Thursday. This is one of those funky old monthly options. And then here's one that expires on Friday. So you have Monday, Wednesday, Friday, every week on the S&P. So we have lots of options that expire. And also on the SPYs and the Qs, have these as well too. We also have the NDX, but the NDX is really a liquid pig. The options are not very good on the NDX, so we kind of avoid it. So the SPX, the spiders, Qs, these are wonderful. And they all have options that expire 3 times a week. Now, I don't know if these are going to also come 5 times a week, but if the SPX experiment works and there's a lot of liquidity on Tuesdays and Thursdays, you can bet that the SPYs and the Qs will also follow suit. Now, the cool thing about this is time decay. Time decay. All right. So think about this. All right. Imagine at the other end of the room, you have a blazing fire going on here. Imagine that this is a fire. Okay. Work with me here. And what you're going to do is you're going to start at one end of the room and you're holding an ice cube. You're holding an ice cube in your palm and you're going to walk this thing across the room. Now, the sensitivity of that ice cube to the heat of this blazing fire across the room is going to be to the square of the distance. So what happens is the closer that you get, you're going to get an exponential increase in heat. So if you move that much closer, it's not linear, it's exponential. So all of this time value decay, or all of this time value will decay by the end of the day. There's no extrinsic value left, only intrinsic value left by the closing bell. So these things erode really, really quickly. And they are very sharp instruments. So the analogy that I use with this is if you ever played baseball when you were younger, probably you saw one of these parks in the United States where it's like mini golf and batting cages and things like that. They're in every town. And you'd walk up to the batting cages and there's a machine that would throw you 10 balls for $1 or whatever it is. It's probably $20 today, but you could pick your speed. You could either walk up to the 40-mile-an-hour pitching machine and take your swings. You could walk up to the 60-mile-an-hour pitching machine and take your swings, or you could go straight up to the big dog, the 80-mile-an-hour pitching machine, and try to take your swings. Now, what I would say is go up to the 40-mile-an-hour one first. These are very sharp, and these are the 80-mile-an-hour instruments, so they decay very quickly. You got to know what you're doing. This is not a place for you to learn options on. Go with the slower, smaller stuff that's much further out and that decays in slow motion. Learn your craft of options before you get into the fast pitch stuff here. Okay, so that's what a 0 days to expiration option is. Let's talk about applications. How are we going to use these? First of all, obviously, we're going to look for a directional. That's the most obvious, but it's actually the toughest. So I'm going to show you a little bit more complicated way in a minute, which is actually much, much easier to win. So most people, when they learn about options, they come from the stock market, they learn about how to trade puts and calls. Puts are bearish, calls are bullish. The simplest possible option trade, but it's also the toughest to win. Okay, why is that? Now, these options have very, very rapid time decay. We just went over that. So you have got to be right on so many different things. You've got to be right on velocity of the move, the direction, the timing of the move, when it's going to happen. And so the whole point here is that you want to get in, get your fair share, get out as soon as possible. This is not a trade where you're going to be sitting in all day, holding and hoping, waiting for something to happen. Now, there are some benefits with this. They are extremely responsive. They're even more so responsive than futures contracts because they have this gamma, which happens as the option crosses at the money. So that plus some of the other Greeks can make these things really, really responsive and move very, very quickly. Directional. So what we'd want to do with something like this, if we're going to go long puts and calls, we want to have what's called a trend day. A trend day would be, if you look at this on a daily candlestick, would be, something where you have a really large real body, or at least a lot of range in here. Maybe we can get a trend day to the upside and then to the downside, which is kind of what today started out like. So trend days only. We don't want to be doing these on doji days where the price just sits in one spot. We can use some old market maker techniques as well too to estimate the value. Say if we are looking for a 1-point move on the spiders, and if the price is 314 currently on the spiders, so we're paying maybe 84 cents for that option. What if it moves 1 point? What are we going to make? Well, it's going to move from 1 point, which is up to here. And so we can estimate that a 1-point move would put that option up to about maybe $1.38. And so we can just set our limit order for something like that. Now, there is another improved option. This is actually a trade that I took this morning. We can use credit spreads. We can actually combine a short and a long option to make it easier to win. And we can mitigate some of those characteristics of the options, such as the time decay, things like that. We can actually put that time decay in our favor. So here was a trade that I took this morning with a credit spread that was out of the money. It was basically located down here as we saw it break the opening range and commit to going in the direction outside of the opening range. We took this trade, and you can see that it wasn't the high of the day. We actually had a reversal back to the downside during the day. But we took this one off up here, got our target, and I'll show that as an example. But we could also play this to the opposite side. As the price fails the opening range, it goes back down into the opening range. We could take this short to the downside with a bear call spread or a call credit spread to the downside, which would be a bearish trade. So very improved probability for a trade like that using spread technologies. So those are some of our directional options. And now we can go with non-directional options. Now, what if the price just sits there and trades within a range? Well, we can use the old iron condor. And you may have heard of one type of iron condor. I'm going to show you 4 different types of iron condor. So we've got a high probability condor, which is what most people are using out there. That's what they start with, is a high probability. And this is where I started years ago, is with trading high probabilities, until I realized I didn't really like the reward to risk. There's also low probability expected move iron condors, as well as the iron butterfly, where we making it so narrow that it turns into a butterfly. Let's go into each one of these briefly so you get an idea of what we're talking about here. High probability iron condor means that these things are way out there. A condor is a bird with huge wings, and that's what this is. It's a very wide trade. So the price can trade within this enormous range during the day, and you can win the trade. Okay, so what's the pros and cons to this? The pros is the high probability, right? So it's a high probability. Chances are pretty good that, you know, say like 80% or better that you're going to win that trade, that the price will expire somewhere in there. The problem with this trade is that it takes all bloody day to decay. So you're going to be in this thing for the better part of the day while you're waiting for your limit order to fire and relieve your obligation. Sometimes people like to leg into these. So in other words, maybe set up one side first and then wait till the price rebounds and set up the other side. But it becomes more of a challenge, because what if it doesn't rebound? So typically I'll still just put on both sides at once. That's the high probability. Now let's go to the opposite side, the low probability. This is where we have a 1-to-1 relationship between reward and risk. So therefore we have a 50% probability of success starting to begin with. And you might say, well, what's the advantage of this? The advantage here is because we've given up more distance, we've made this more narrow, it's actually much faster, because these options will, because they're more filled with extrinsic value, there's much more time value in them. They decay faster. So I don't have to stay in this one all day long, number one, to get a reasonable profit target. Number two is the risk is much better. The risk reward is much better. So this is realistically a trade where I could say, well, look, I'm comfortable with this level of risk. So if the trade ends up going outside of this, and if I step in front of a trend day, I'm okay with this. I'm okay managing around this level of risk. Everything is about risk and not necessarily the win rates, right? Now here's a hybrid, which is an expected move, iron condor. If you've ever heard of some of the tasty trade guys, or, you know, the old Thinkorswim guys, they will always talk about setting up trades at one expected move, or one standard deviation is another way to put it. And so basically what we're setting is, this has got a 68.2% probability of success. So the area under this is the kind of like the old bell curve, right? 68.2%, that's one standard deviation plus and minus. Okay, I will take questions at the end of today's presentation. So if you could hold off until the very end. Otherwise, I've found that I never get through these things, and everybody gets mad at me. All right, so I'll take questions at the end. So that's the expected move iron condor. Now, iron butterfly means what we're doing is we're putting the short options, we're marrying them together. So the short puts and short calls are one strike right there, boom. Now, why on earth would you do something like that? Well, the credit that you pull in from something like that, because the options are right there at the money, is obscene. It's big. The big credit for pulling something like this in. And as a result of that, these options decay super fast. So this is currently my favorite type of trade for 0 DTE if I'm looking at a range day. This creates profits much faster than other versions of the iron condor. I have a smaller range to work with, so it puts more pressure on me. It puts more emphasis on identifying what is a range day. Okay, so which one is best? It really comes down to you. So again, like I said, most retail traders will start off with a high probability condor until they get run over a couple of times and say, I don't like the risk management of these. You can manage them actively. It's possible to do. These are actually all essentially the same in the way that you manage them, right? So risk management, if you're doing it right, there's really no difference, but there are different characteristics. I would say these ones here, like high probability and the low probability, these are better if you've got a job, you can't be sitting there watching the screen all day long, because you can, with a high probability, you can either set up limit orders, you can set up conditional stops, things like that, or the low probability, you just don't even need a stop. You can set up a limit order and set your stop. Your stop is basically based on the position size. Expected move is a little bit tougher because the risk is a little higher, so you don't necessarily want to just let them go. Iron butterflies, I actively manage these. Actively manage on both the limit and the stops. Okay, so everything depends on what works best for you. But don't forget, anybody can enter one of these. The skill comes in knowing when to enter and when and how to exit. You've got to avoid the trend day. Trend day is where the market opens up and it just keeps on moving, right? Or it starts in one direction and then the bottom falls out. This is what we've been seeing lately, is a lot of that kind of stuff. Okay, so a great offense is the best defense. Avoid trend days. Never let a profitable trade turn into a loser if you can help it. And so in my mind, my favorite way to play these is to get in, get my fair share, get out, get on with my day. I don't want to be sitting there managing this thing for 6.5 hours. And don't forget, if you take a loss in the trade, you've got 2 more opportunities this week to trade again. Or later on this summer, you'll have 4 more opportunities to trade again. So it's not the end of the, if you take a loss, it's not the end of the world. Get right back up and start again. Now, I'm going to spend just a very short period of time talking about calendar spreads because they're very effective, but they're not very good in this market right now that we're seeing because we have elevated implied volatility. But let me tell you about this just so I can check this off for you that I've walked you through what a calendar is. It is a time spread. You are selling the front option. Front means today, the option that expires today. You're selling that option that expires today, and you're buying a back option, which is normally about a week out. It can be whatever you want it to, but they're at the same strike, but it's a difference in time between the 2 options. That's why they call it a calendar spread or a time spread. What's the edge here? Remember this little graph that I showed you through with the fire at the end of the room? Well, remember that with the back option here, the option that you buy, the fire is that much further away. And it's this option is going to expire. This is today's option. That's going to expire. This option, which is a week out, is not going to decay that much today. So the differential between the 2 is what you're trading. You're trading for an option to basically retain most of its value, which is the long option, and this option will lose most of its value. It's a very interesting trade. Again, this is not an edge that will ever go away. This is a fundamental edge and will never disappear. However, you've got to take care to keep that edge. It's not as easy as just putting something on every day because they're very sensitive to changes in implied volatility. So what are the risks? The risks are you step in front of a trend day, or there is shrinkage. Shrinkage is the evil risk with this trade because you're not used to this with vertical spreads, but the entire trade, the entire expiration graph can shrink like this. And it would shrink because the back volatility is collapsing. This is why we don't trade these on higher volatility conditions like this, because what happens if all of a sudden there's certainty that comes to Ukraine in the next day or 2? Wouldn't that be great, right? But all that back volatility is going to collapse and these calendar spreads will be next to worthless. So we have to adjust for trends. We can actually double these. We can turn a single calendar into a double calendar quite easily. Okay, so the problem here is you end up slowing the trade down and it will double your calendar. Capital. Exits and management. These tend to turn into almost an accounting function. Staying on top of these trades can be difficult. It's not that difficult. It's just a lot of numbers to watch for. You have to understand what your investment was. You have to understand what your volatilities on the entry to the trade are. And so this is why I've built this tracking sheet that I share with my customers. So it's just a really simple way to automate the functionality in the management of the trade. Now, condors versus calendars, which is better? Calendars are actually even faster. They are the fastest trade that I know of. If you have a range-bound day, you have very, very quick decay due to that fundamental edge. However, it puts a lot more pressure on you to identify all the correct criteria before you can take the trade. So I always tell people, like, if you learn how to trade calendars, it will make you a better trader because you're going to need to see things in more than one dimension. But right now is not the time to trade them. So at least I want to check this off and let you guys know about these so that you can use them when conditions are a little quieter. Now let's get into charting. Everybody loves to talk about charting. What technical charting tools do we need to help us with zero DTE? So first question is, what studies do I need? Not on your life. Do not use studies. Don't use the delayed studies. Well, I'm using a MACD and an RSI with a staggered stochastic. No. It's going to be way too slow. You'll never catch up with things. You've got to focus on price to frame in the battlefield. Let me show you a couple of techniques that are really simple and you can use with just about anything. So first of all, price gaps will happen. A price gap is where the S&P will trade outside of normal market hours during the day, right? And it opens up at a different place. So everybody sees futures. So when the futures will open up in a certain direction, we do get price gaps. We got a price gap this morning. Every day we're getting price gaps. It used to be a really rare thing. Now they're constant. So the S&P will gap up or down every day. And here's an example of a gap and go. So here is the previous closing price of the S&P. The next day it opened up down there. Did it make any attempt at all to close this gap? No, none whatsoever. It just kept on trucking in this direction. And so this is a gap and go, and it tells you the price is trying to tell you something. The price is trying to tell you, hey, I'm in distribution mode and I have no interest in going back up there. So on a day like that, that's more likely going to be a trend day that we're going to avoid with something like an iron butterfly or a calendar spread. We're going to use a directional type of trade with something like that. Now, some of these days we'll get a gap, and here's a good example of, like, here's a gap, but the price gaps up and then it filled the gap, or it got pretty close to filling the gap before it started to move. So sometimes we'll have small gaps that do get filled during the day, and those are more likely going to be a range day. Here's an extremely important tool. This is the opening range. So what we're going to do is we're going to look at the first 30 minutes of the market after the opening bell, and it sets up a range. And it's kind of like the market telling us what's going on. And we can identify this range. Sometimes we'll get opening ranges that are really big, and it's part of a trend day. And so that's a big range right off the bat. And you can tell that the market's on its high horse in one direction or another. A day like this day, you could see was pretty much a range day because most of the trading in that day stayed within the opening range. So a couple of recent examples. Here's last Friday. We had a big trend day. Here's the opening range. The opening range was going from upper prices to lower prices, and it just kept on going. You'll see this all the time too. You'll see the price test the bottom of the opening range on its way lower. Or sometimes you'll see it come higher and then test the top of the opening range and then take off again. And then here's another example of a range day where most of the price action was spent during that opening range. And so we can get a very quick read within, say, 35 minutes or so as to whether or not we have a good probability of a range day or a trend day. Okay, so that's the opening range. There's also the expected move, which is something that we calculate right off the bat. The expected move is in the option chain for today's options. And so we're going to get a plus and a minus expected move. And believe it or not, the price does react at these levels. Everybody sees what the opening expected move is of the day, and they track those levels, and the price does react at those levels big time. So in some ways, we get almost a second range. There's the opening range here, and we get the plus and minus expected move. we've got a couple of price levels that we can trade against to determine whether or not this is a trend day or a range day. So what I would say is keep it simple, guys. Use the KISS principle. Do the best job you can to avoid being trucked by a trend day if you're going to trade something like an iron condor. And if you do see something working into a trend day, then try to take it directionally. But you can't win from the sidelines if you wait for something to feel good. If you wait for the setup to feel good, you're probably too late. Don't forget that these are also 3 times a week, soon to be 5 times a week. So if you do get knocked down, get back up, get in the fight, learn from this, learn your specialty. Okay, so that's charting in TA. Let me give you a couple of examples here. Calendar spread, this is from a while ago because we haven't done too many lately. But here's an example of one that was 7 minutes, a 7-minute hold time for $125. This is how fast the decay can be with these during the right conditions. So we entered at 10:12 in the morning and we're out by 10:19. That's my kind of a day to hit my number in 7 minutes. That's what I like to do. An expected move iron condor is a little bit wider, gives you a little bit more room, but what you're also seeing in this case to earn $50 or a 15% return on risk, it took, over an hour, like an hour and a quarter or so for this one to mature to that point. So a safer trade is going to take you longer. Here is a low probability iron condor. A low probability iron condor where we're looking at the risk is 250, the potential reward is 250, and I decided to get out at $50 or 20% return on risk. You can see this one also took about 2 hours to mature to that level. So it does take a little bit longer for some of the, I'm doing air quotes right now, safer trades. Okay, so that's a low probability. Here is a directional spread that I took this morning. So here's this morning. Once the price set up the opening range, you can see the opening range, and then it did commit to breaking outside, at least for a short period of time this morning, and it even retested the opening range from above. So positive trend, opening range breakout. So what I did was I went long, or not long, but I went into a vertical spread. In this case, this is a put spread, put vertical spread, or also known as a bull put spread. So $1.60 credit or $160 into your account immediately. And then just a few minutes later, we're out for $110. The differential is $50. So on a risk of $100, made $50 or 0.5 R, hold time 34 minutes. That's my kind of day, right? If you can scale up to something like this, being done with your day and getting your active profit target within 34 minutes, and you got the rest of the day to do whatever you want. That's my kind of trade. And there's also the iron butterfly. Again, this is my favorite one to trade with range-bound markets. In this case, the whole time was 17 minutes. We're risking $400 a contract. In this case, we used 2 contracts. We got $200 of profit for this, or 25% return on risk, 0.25 R. So again, these things operate very, very quickly. You can see in at 10:19 or 10:12, out at 10:29, 17 minutes of hold time. Here's the performance numbers on, these are iron butterflies. So last year in 2021, we took 111 trades. We won 108 of them, 97.3% rate. Profit factor was 6.9. This is also important just because you can make 97% and you can still lose money, right? If your losers are that much bigger. But the profit factor means that for every dollar that we lost, we make $6.90. So you can scale that up and you can do quite well with that. So far in 2022, we've had a lot of trend days for the last month or so here. So we've not taken a ton of trades, but we started out 26 for 27. So we're still running at about the same win rate for these and still actively prosecuting these trades if the setup is correct. So those are a couple of recent examples. And let me just take a minute here to put it all together, and then I'll keep you guys on track for your timing today. Okay, so there's one, in my mind, there's only one narrow path to success. I've been doing this now since 2005. I've been helping people since like a week after that. People found out that I quit my job, so they start knocking on my front door and saying, "Can you help me?" And I love helping people. This is what makes this worth it, right? Because I want to be able to help people achieve that financial freedom. So I have only seen one path to success. I don't think that there's more than one of them. I think with the human condition, the way that we are, the way that we think, there's only one way you can do this. So let's kind of walk through here. Growing your pile. Don't focus on trying to grow capital using traditional methods. Focus on creating income today using passive and active income from options. So we didn't really show the passive, but active today. Use options, learn about options. Don't be intimidated by them. They're actually very simple. If you've ever bought an insurance policy before, if you've ever bought a coupon before, you've traded options and you can figure out how to do this. The cost is knowledge and you can do this. Everybody here can do this. $100 a day. Don't try to climb the mountain of financial independence all at once. Don't go from zero to forcing yourself to make $5,000 a week just to replace your income, just because that's what I used to earn. And by God, I'm going to make that right now. Ease your way into it. Pick something reasonable, like $100 a day that you can do over and over and over and over and over again. And then maybe you can move that to 200 and then eventually 500 and then eventually 1,000. Let compounding work. Understand that 0-day options have a 6.5-hour lifespan after the opening bell. Display very specific characteristics for time decay and gamma that can be used as edge for short and long option trades. These will not go away. Iron condors. You can use iron condors if you have a range bound day. You can use different types of them that I've showed you. You can also use calendar spreads when things are a little bit quieter than today. These are for low volatility markets. And then lastly, trade small to begin. Please trade very, very small. You might want to start on the spiders or Qs and don't start with a big dog SPX right out of the gate. Don't forget, guys, repetition is the mother of skill. If you want to get somewhere, keep doing it. It's all about the repetitions. This is why Tiger Woods, when he was golfing and we didn't have a bum leg, would sit out the range for hours and hours and hours. Even a guy that was that good is still focused on repetition. So there you go. Now, just give me a couple of minutes here and I'll put you right back on schedule. Where do you go from here? If you're wondering how you get started, I just gave you the whole recipe for how to do something like this. But maybe we're missing a couple of details. You may not know how to get started from here. Consider joining Ready, Set, Trade. We're a community of traders who seek high probability, low risk trades in the options and futures market, seeking to earn $100 a day. We provide the structure and the guidance and the systems that show how to do this. Goals are for people who care about winning once. Systems are for people who care about winning repeatedly. So what we do at Ready, Set, Trade, we run a live daily trading room. I'm on every morning, 5 times a week, daily newsletter. We have a live online community that you can interact with and ask questions to. We have live trade notifications and adjustments, multiple trading courses. It's kind of like the Netflix of learning options trading and learning how to analyze markets. We also have strategy briefs, research notes, everything you really need to get started with this. So today, we're offering the 0DTE Mad Hedge Fund sale, which is $99.99 for learning about the 0DTE options. So this will give you everything that you need to get started with 0DTE options and also access directly to me for any questions that you have. Now, unfortunately, if you go to readyset.trade/mad, please don't do this on an iPhone or an iPad device because it won't work because we're not on the Apple Store. So what's our overall performance at Ready, Set, Trade? We have about an 81.9% win rate on all strategies across the board, 2.54 profit factor. So you can see actually the 0DTE trades are the best trades that we do across the board. So we have good numbers, but 0DTE is even better. Here's a quick view in terms of what's in the course. We're going to go over the zero DTE advantage. We're going to go through different iron condor strategies. We're going to go over iron butterflies. We're going to go over calendar spreads, show you how to manage those. We're going to show you different directional trades, and then show you how to make decisions, whether or not to trade what strategy or whether to go short, long, sideways, whatever you have, right? Everything that you need to know to get started with this. Plus, you get member access if you buy the course too. You get access to our free 10X Tribe community, which provides signal scan access as well as access to the community. So quite a lot of value for one simple course. So what's that link again? That is readyset.trade/mad. And at this point, I will take your questions. And let's see, the first one here is with a low probability iron condor, what are your short wings set at in terms of the delta? Generally, I'll start out with about a 30 delta for those, and then I'll tune those a little bit depending on what the skew of the put and the call are. Aren't calendar spreads better since you can sell the short-term option versus a long-term position and sell several weekly options before the long-term expires? That is true. However, there's a lot of moving parts behind calendar spreads. There's a lot of movement with the change in volatility. And right now is a kind of dangerous time for somebody to be learning calendar spreads with volatility likely to revert to the mean, which would be a little bit lower here. So that will cause shrinkage, and I don't recommend doing them right now. Do you find that most Fed announcement days are range bound prior to 2 o'clock? Yes, but what happens is the market will hold its breath and will hold that implied volatility almost all the way until 2 o'clock. So generally, we do not trade during Fed days. What about the long strategy instead of your short strategy? You could do these with debit spreads just as easily as you could with credit spreads. However, short-term directionals, I find credit spreads a little bit easier. Do you receive alerts? Not on this class. This class is for the class only. Let's see. Since we're trading indices, does that mean that the zero DTE strategy can be scaled without liquidity being an issue? There is no problem with liquidity on the S&P 500. Seriously, it is the big dog. You can literally do as much as you can, as you want to. You will not move that market. You will not have liquidity issues. And especially since we are playing at the money, there's no liquidity issues on the SPX or the SPY. Does the course specifically teach how to determine which type of trade to put on? Yes, it does. Yes, it does. So with that, I think we got just about everything answered. John, I'm going to return it back to you. Thank you very much. I appreciate the Mad Hedge Fund Trader inviting us to participate once again. I look forward to seeing everybody online, and thanks for your questions. Thanks for your time and attention. Bye now.